Hello everyone, this is Patrick from AllQuant. Right, so the first half of 2022 is over. So let's see how the strategies taught in our course performed during the first half of 2022. So as usual, we will start by getting a sense of the kind of market environment that defined the first half of this year. We will then look at how the individual strategies performed under this environment and whether it is in line with expected behavior. We will then look at the overall multi-strategy performance. Okay, so the second quarter was pretty much an extension of the first quarter. Both stocks and bonds continued to go down together. So needless to say, this was a tough environment for most balanced portfolios out there. Now, US Treasuries stabilized somewhat towards the end, but it still ended the first half down significantly. Our risk parity allocation did not change much throughout the 6 months, with the bulk allocated to IEF. And since both SPY and IEF went down together, risk parity suffered one of the worst period in history, and this is within expectation. Note that this is a simple two-asset risk parity model, so with more asset classes in the portfolio, the performance might be somewhat better, but it would also be down. Even commodities gave way towards the end of this period. And looking around at some of the large risk parity funds out there, they are also suffering one of their worst periods since their inception. For our trend following model, the exposure to stocks was around 110% at the start of the year. It only seriously started reducing exposure after April, and it ended the first half with slightly less than 70% exposure. Hence, it is to be expected that trend model performance is roughly in line with DIA, which is the ETF tracking the Dow Jones Industrial Average. The first half can be classified as a volatile period, as represented by the VIX chart. However, the VIX swung around quite a bit, within a range of 20 to 40. As a result, our volatility risk premium model was more active during this period. The model navigated the first quarter relatively well, but suffered during the second quarter due to the whipsaw action in the VIX. But overall, the model still outperformed the S&P 500 for the first half of 2022. Sector rotation did well this quarter in terms of asset allocation. It started the year with full allocation to stocks. It then allocated heavily into TLT in February, which turned out to be a good move as long-term treasuries did not go down as much as stocks. It then drastically reduced allocation to TLT in March, just in time to benefit from the strong rebound in stocks. As a result of the timely adjustments, sector rotation outperformed both SPY and TLT for the first quarter. Now, moving into the second quarter, sector rotation maintained a relatively high allocation to TLT. TLT dropped slightly less than SPY in Q2, so the higher allocation to TLT helped. The second thing that helped was in the sector allocation itself. Sector rotation allocated mostly to defensive sectors, and these sectors were more resilient during the stock market drawdown in the second quarter. Overall, sector rotation did better than SPY for the first half. So this is the second quarter performance of the different sectors in the US market. All sectors were down. Even the energy sector, as represented by XLE, was also down, although to a lesser extent. However, not all sectors are the same. Defensive sectors lived up to their name and were more resilient. The defensive sectors were, of course, utilities, healthcare, and consumer staples. So this helped our sector rotation model, which were mainly allocated into these defensive sectors. So the combined multi-strategy portfolio outperformed the S&P 500 slightly for the first half, but at the end of the day, it's also down for the first half. Okay, however, the multi-strategy portfolio's performance is much less volatile than that of the S&P 500, which actually experienced more drastic moves. Okay, so this is the expected resilient nature of the multi-strategy portfolio. So in summary, the first half of this year is challenging for risk parity because both stocks and bonds went down together. All right. In fact, not only just stocks and bonds, most other asset classes also went down. However, sector rotation and volatility trading helped to stabilize our multi-strategy portfolio. Okay, so there is no one star performer for the first half, but we can assign a shared star for 3 of our models because they are performing largely in line with expectations. Now, risk parity is also doing what it's supposed to do, just that this is a unique period that is tough for a pure long-only asset allocation model. At the overall level, the multi-strategy portfolio did better than SPY and was more resilient on the downside. So this is in line with our expectations. Okay, so this is our model updates for the first half of 2022. Let's see how the rest of the year pan out.